Hello, hi dear students. So in today's class, we'll continue on the accounting concepts for business combination. So actually there are four steps to account for the business combination, and step one is to identify who is the acquirer. So this is important step to see who is the acquirer and who is the acquiree. Yeah, so there are some concepts in which we can identify who is acquirer. There are bit complexities are also there. So I have given few examples in today's class. We'll go through all the examples and see how to identify the acquirer. So then the next step is acquisition date, how to determine the acquisition date, and then identify the assets and liabilities that have been acquired, and finally how to measure the goodwill and capital reserve. So these are the four steps we need to follow to account the business combination. So in today's class, I will touch upon how to identify the acquirer. Maybe in the next class, I'll try to take the remaining steps. Okay, so how to identify the acquirer? So we have to see there are three conditions basically. If the acquirer is having more than 50% of the acquired entity, so then we can say the acquirer is having the control. If the acquirer is having the control, yes, he will become the acquirer. So more than 50% voting right, the acquirer should have. So that's the first condition. And second is the acquirer should also have power to appoint the board of directors or to remove the board of directors. So that control he should have. So that's the next condition. And third one is if even in case if the acquirer does not have the absolute voting rights, even if he has the potential voting rights, even that can be considered as a kind of a control that the acquirer is having on the entity. So even in that case, yes, he will become the acquirer. So either the absolute voting right you should have or the potential voting right you should have. Okay, so I just given the basic conditions. Yeah, so all the accounting under the business combination should follow a method called the purchase method. So I will also talk about in detail how the purchase method of accounting should be followed in the subsequent class. Okay, so just to summarize, to qualify as acquirer as part of Ind AS, these conditions should be satisfied. So the acquirer should have the absolute voting right, or at least the potential voting right you should have. And also, if the voting right means he will also eligible to gain the return for his prorated investments. So basically, he will be owning more than 50%, either the absolute voting right or the potential voting right, and which means you should also be eligible to receive 50% or more than 50% based on his voting right to receive the returns on his investment. So that's how the acquirer needs to be identified. So here we will go through few examples. So this is the first example, so probably you can take some time to read the question, then I will give explanation. Okay, so here there are two steps. One, there is an initial acquisition, and second, there will be some acquisition based on the potential voting right. So you can exercise option to get more shares. So here shares of X Limited held by P Limited, it's given that 40,000 shares they are holding, and there are other two shareholders of X Limited. The first shareholder is holding 35,000 and the second shareholder is holding 25,000 shares. So in total, company X is having 100,000 shares. Okay, so in terms of percentage of holding, P Limited is holding only 40%, and the first shareholder is holding 35% and second shareholder is holding 25%. So here no one is having more than 50% of the shares, so which means none of them having control, absolute control over the entity. So here, as on this time, there is no acquirer per se from business combination in AS 103 perspective. And see, it is given that there is the share options facilities available, so through which P Limited can buy another 25,000 shares in the next maybe in the next 12 months it has been given. So if the shares, if that options have been exercised, then P Limited will ultimately hold 65,000 shares. And similarly, there are some options available to first and second shareholder. For the first shareholder, he will get 2,000 more shares. So his shares will become 35,000 to 37,000. Similarly, for the second shareholder, another 2,000 shares he can buy. So which means his shareholding will become from 25,000 to 27,000. So post exercise of share options, the percentage of holding will be P Limited will ultimately hold 50.4%, and first shareholder will have 28.7, and second shareholder will have 20.9. So in this case, P Limited he will be holding more than 50%, just above 50% control on the combined entity or the merged entity. So we can say now that P Limited is having the control over X Limited, and so P Limited is acquiring the X Limited. So here the acquirer is P Limited. Yeah, I hope it's clear. Otherwise, you can watch this video once again. It's a bit important to know who is acquirer from Ind AS 103 perspective. Okay, then I will move on to example 2. So here also you can just read. I'll give few minutes. Okay, so this is also a bit simple. So here shares of Mira Limited held by Mira Limited, it is given as 100 shares. Similar shares of Mira Limited held by Zira Limited is another 50 shares. So in total, the number of shares of Mira Limited is 150. So out of which 100 being held by Mira and 50 being held by Zira. So of course, in terms of percentage, Mira Limited is holding Mira Limited is holding 67% of Mira Limited, and Zira Limited is holding 33% of Mira Limited. So meaning 67% shares of Mira Limited is held by Mira Limited. So we can conclude Mira Limited is the acquirer from Ind AS 103 perspective. Okay, so now I will move to the third example. Yeah, so please read this question also. So I have also given a short summary of this question. So just to brief you. So here company B merges with company A on one-on-one basis, which means for every shares of every one share of B, one share of A will be issued. Right, so post merger, it is given that company B has 20% stake in the combined entity. So which obviously means company A will have 80% stake of the combined entity. So since company A is having more than 50%, so company A can be concluded as the acquirer. Okay, so that's good. Then I will move on to the fourth example. Yeah, so for fourth example also I have given you a summary of this question. So of course you need to read the question in detail and then make the summary out of it, because in the exam they will give questions like this paragraph type. You can summarize in bullet points what the question means, and then it will be easy for you to write the answer. So I have summarized this question. So here also company B merges with company A. So here the merger terms is that company B shareholder will receive 10 shares of company A for every 1 share in company B. So company B shareholder will receive 10 shares of company A for every single share held in company B. And then it's given that company B ultimately owns 70% of the combined entity. Okay, so since company B has 70% of the combined entity, we can conclude company B is the acquirer. But one small catch here is that in the example it is given that company B merges with company A, which means company A will be the surviving entity from legal perspective. but from accounting perspective, company B is acquirer. So that's a bit, I mean, we can have a situation where from legal perspective, the acquirer might be different. But from our point of view, from Ind AS 103 point of view, we need to be decided who will be the acquirer from Ind AS 103 perspective. So, I mean, we have to follow all the accounting based on who is acquirer from the Ind AS 103 concepts point of view. So in this case, even though company A is the legal acquirer, company B will be considered for the accounting purpose. Okay, so that's important. Then I will move on to the next example. Yeah, so here also I have given you a brief of the question. So here ABC Limited incorporates a new company called Super Limited, and the main purpose of incorporating Super Limited is to acquire 100% shares of the Focus Limited. But it is not that all the cash flow required for acquiring Focus Limited will not be sponsored by ABC Limited. Instead, Super Limited will go and obtain a third party bank loan, XYZ bank loan. So the major portion of consideration will be paid out of the loan consideration, not out of equity from ABC. Okay, so here, Super Limited will be holding 100% equity of Focus Limited ultimately, and so we can consider Super Limited is the acquirer, and they will also have the complete power over the Focus Limited. Power in the sense the management power, all the decision making will be taken by Super Limited on behalf of Focus Limited. So here Super Limited is the acquirer. Done. Okay, then I will move on to the next example. Yeah, you can you can take few minutes to read this question. So here also entity B is a legal acquirer. Yeah, I've also given you a snapshot of the question in this slide. So basically we have entity A and entity B, and the number of existing shares is 30,000 in case of entity A and 60,000 in case of entity B, and face value of both the entity is rupees 10 per share. However, it is given the market price of entity A is 20 per share, but market price of entity B is 105 per share. Okay, so it's given that new shares issued by entity A to shareholders of entity B is 2.5 shares to all the 60,000 shareholders. I mean 60,000 shares. So 60,000 into 2.5, 150,000 shares needs to be issued. So remaining shares post acquisition is 180,000. Yeah. Then let me move on to example 7. Yeah, please take some time to read this question as well. So here company A owns company B and company C, and company A forms a new company called company D with nominal equity only, which is 1% of the entire share capital requirement. And then company D buys company B and C, the back-to-back purchases happening by obtaining the public money. So 99% of the investment will be sponsored by public money, and only 1% will be sponsored by company A. So which means ultimately company A owns only 1% of the company B and C, and remaining 90% will be owned by public. So in this case, company D is the acquirer of company B and C, because it has paid the full cash required by obtaining the loan or the third party equity, and also it owns the complete control over company B and C. So from India's 103 perspective, company D is the acquirer. Okay, so I will stop class with this today, and we will discuss in detail on step 2, step 3 and step 4 in the next class. Okay, but please read all these examples in detail, and then in case if you have any doubts, please give a comment, let me review, and then I'll get back to you in the next class. Okay, thank you.